What's the anatomy of an uptrend, anatomy of a downtrend, how we start from the top down approach. We spent a lot of time on Google, starting from the monthly time frame. Then we went to the weekly time frame. Then we went to the daily time frame. I even showed you a bit of the intermediate time frame, being the 60 and the 30-minute time frame. And then we mentioned that this morning we were going to get right into the buy and sell setups. To where we can actually execute these said setups. So let's dive right in. And one of the things that we talked about yesterday, and I was kind of harping on, was that what we want to identify is the stages in all timeframes. So, and I kind of paused and we made a note mentioning that in a lot of cases, okay, there's going to be different stages in different time frames. So it's our ability as a trader to analyze what stages each time frame is in. And just as a quick little rehash from yesterday, we started with the monthly as the high time frame, and then we analyzed whether that is going to be in an uptrend stage 2, downtrend stage 4, or stage 1 or 3, which is sideways. Furthermore, we talked about that same concept on the weekly time frame and also on the daily time frame. Okay. Now, what this is giving us here is the step-by-step process and the stage matches. So I'll read this here to the left. All right, and then we can kind of dive in and unpack what this illustration is telling us. All right, but before I start that, let's do some terminology here. Anytime that you see a small m, okay, a small m, that is going to stand for lowercase m. That's going to stand for the minor time frame stage. Okay, too early to start spelling correctly here. So minor, it's spelled right there. Minor, which is going to be the small time frame. Okay, the low or small time frame stages. Okay. Anytime that you see a big uppercase M, that is going to be the macro stage. Okay, so minor M, big M. Now, this is already giving us a context. So this is going to be a bullish setup. Okay, so it's going to be a stage 2 uptrend. Okay, aka higher high, higher low, which we discussed yesterday. Now we're going to take this a step further and build upon that foundation. Okay, so this is a stage 2 uptrend. Okay, and we already had the rules yesterday. This is giving us a macro bullish stage 2. So in other words, the monthly, weekly, or daily, whichever time frame you are utilizing for your high time frame, is giving us a stage in terms of 2, aka uptrend. Okay, that's important to note. All right, so what this is giving us is the 1, 2, 3s. Okay, the 1, 2, 3. So we already know from the bell curve. Let me clean this up. I'll put the bell curve here. We already know that stage 1 is that accumulation stage or build-up stage. Okay, stage 2 is going to be that uptrend stage. Stage 3, distribution stage, topping. And stage 4 is going to be downtrend stage. And then it could potentially rinse and repeat again, either 1 or this could be 3 if we would get to continuation breakdown. Okay, that said, there's the accumulation. There is the bell curve. All right, now what this is giving us is, this is giving us also the micro stages. So we have micro stage 1, basing, bottoming, kicks off into a stage 2, uptrend, M2, small m, M3, topping period, M4. Okay, now this is not a downtrend. This is just going to be what's called the correction segment. Remember, we talked about this yesterday, impulse correction. Okay, so what we're looking for is not to be this as a downtrend. We're utilizing this on these small time frames. Okay, the small time frame here. Okay, and we're utilizing that short-term correctional segment in the context of an uptrend. Okay, so we're letting that come down low on that stage 4. Okay, then after stage 4 comes what? A potential bottoming period, stage 1. Okay. The next slide is going to give you that the step-by-step process, but this is just the illustration. Okay. After one, potentially after the correctional stage 4 down, in this case in a bullish uptrend stage, after one comes two. Now two is going to be that what? That impulse wave. If this trend is going to continue, it's going to be that impulse wave. After one comes two. So we should get this uptrend and this uptrend up segment impulse wave to create that new high. So this is going to be the impulse segment. After stage two comes a bit of a topping period. Okay, not a reversal trade, but just a 3 pause. And then stage four would be, again, like I had just mentioned, not a counter trend, but just a correctional segment. And then it rinses and repeats again. It goes to stage one, bottoming tail, things like, what we're going to discuss a little bit later, how we can add confluence to this, changing of the guard, etc. We're not there yet. After the bottoming period, okay, and I think Jason and Randy talked about what was once resistance, okay, it broke and is now support on the other side. This is what's going to help us add confluence at these areas. Back to the stages. Once this corrects, short-term stage four, bottoms out, stage one, okay, bottoming period. And then if this trend is going to continue, law of inertia, okay, things tend to stay in motion until a greater or equal force, okay, which we're going to discuss, the higher time frames, okay. After bottoming stage one, we have a stage two. And if you notice here, there's something called matches. So let's talk about this really briefly. Notice how we already have a context and a condition, which is giving us a macro bullish stage two, which we discussed. Okay, this is the variable that is giving to us. Okay, so that said, since the macro or the higher time frame is in stage two bullish, what we're looking for is the smaller time frames to agree with the higher time frames. So notice how we have a match point at these circles. Okay, these circles are very precisely placed, meaning that this is going to be the place where we would be executing based on the match. Well, match of what? Match of the smaller time frame, essentially micro, stage two, and then it's matching with the bullish stage two of the macro or higher time frames. Okay, so once that has a stage match, you get long as a setup. Okay, get long as a setup, and then you would enjoy potentially your impulse new wave high. This is the impulse wave. And then when we get to stage three, this is going to be where we're going to be talking about taking profit, things like that. And then it just rinse and repeats this all over again until eventually, potentially, a trend may potentially change. Okay, which you don't know that until it happens, but we're going to talk about higher time frame analysis where we can get an idea of probability where those trends would go from, say, an uptrend stage two to a downtrend stage four. But typically, there's going to be a stage three distribution stage before that. Okay, so if you look at the, if I just kind of kick out here for a moment, the kind of the document that we provided here. Okay, what we just realized, what we just covered was basically a stage two uptrend. So in this quadrant, I kind of built this out based on those stages. So if you notice here, your standard quadrant, we have quadrant 1, 2, 3, and 4. Okay, I'm just using this as kind of like a VWAP or a 20 EMA filter, what have you. We're going to be talking about this in a moment. Okay, but we have an uptrend stage two, right? So we want to be buying that pullback into support or demand in the context of an uptrend. Buy to enter long. And then to be taking profits, we have to have equal to or new highs. Okay, so you want to be selling out and scaling out when you get new high segments. Okay, we talked about that yesterday. So in this upper two quadrant, okay, notice we're still in an uptrend, but you see where these circles are placed? They're placed on new high, equal to or new high segments. So buying to enter the correctional pullback, short-term stage four, buy to enter, positive, what we call changing of the guard, which we're going to be discussing today. You got the trigger, pull the trigger, stop loss. We're going to talk about that as well, putting our stop below where that level is going to be proven wrong, if that is the case. And then if this trade is going to be working out, we're going to be scaling out, selling new exit on equal to or new high segments. And then again, you could still ride that trend so as long as that trend does not change. Okay, so later this afternoon, I'm going to be diving deeper into this concept, but I just wanted to show you where these circles are placed, exactly strategically placed and drawn, illustrated based on these what's called stage matches. Stage matches. Okay. So it kind of looks something like this, with some key important points. All right. Note that the macro uptrend is made up of a series of repetitive micro stock cycles. So we always talk about buy low, sell high, right? Markets just don't go up, 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 up. They do what's called, they correct. They have correctional segments. Okay. So this is basically telling us that even though the macro trend is up, okay, it's still made up of a series of repetitive micro cycles, meaning that you want to be basically buying low in the context of an uptrend. So let that market correct into better low prices for you to execute to get, in this example, long or bullish for that next wave higher. Okay. Now this is just trend. This is trend trading. Okay. This is trend trading. Stock trading traders look to buy qualified, not all levels qualify. So we're going to be discussing this. Okay. We have to score our trade and qualify our trade. Every dip or pullback in or breakout, as long as the macro stage is also up, aka stage 2. The question is not if I should buy, okay, but when. Okay, so we talked about this earlier in section 10. It's not a matter of like what to do or if I should be doing something. It's more if you're analyzing everything the right way and putting all the pieces together. It's more of a matter of when I should be buying. Okay, so the market's going to give you trend, structure, location, all of that if you're doing it the right way. So it's not about like what should I be doing. It's more of a matter of when I should be doing that. So planning your attack. Okay, some of the best traders in the world, they just wait, and then boom, they attack it. Okay, so they know what they should be doing. So it's not a matter of if, but it's more a matter of when. Okay, to buy that dip or pullback or breakout. While the higher peaks and troughs signify that the stock is in a macro stage 2, note that the macro uptrend itself has a micro stage 1, 2s, and 3s, and 4s, of course. So that was a lot of numbers, too early. Okay, in short, all it's really saying is, again, macro stage 2, okay? And now I'm sounding a bit repetitive here. All we're trying to do is match stage the micro. This is going to be the micro stage 2. So these little areas right here, kind of where I'm circling, are going to be very key. Okay, might want to make a note for later this afternoon. One of my favorite topics to talk about is what's called changing of the guard. Okay, changing of the guard. And we'll discuss that in a little bit. Okay, changing the guard. So that's what's going to help us execute these said timings of when to enter. As a tip, okay, stock trading traders are buy when the micro trend, aka the small time frame, is in sync, okay, lined up with the macro trend. Herein lies one of the most master keys to trading the accuracy on the buy side. The question of when to buy is now answered. A buy is triggered each time there is a stage-to-stage match. Do not miss this concept. It is priceless, okay? And I totally agree with that. This is priceless. I mean, this is really all I do. As I analyze trends, they change. I analyze it, and then I change with the trends as well. And we talked about the analogy yesterday, being the ocean. Okay, liquidity. That's all markets are, folks. Is liquidity. All right, and it's giving us waves to get in and waves to get out. Just riding the waves as a surfer. Here is the step-by-step process. Okay, so the timing of the buy. I kind of like this exercise here. So again, same thing here, macro stage 2. That's a giving variable. So monthly, weekly, daily, what have you, okay, is up. Okay, great, check. Okay, but that's very important because the small time frames don't mean nothing unless unless macro picture, higher time frames are analyzed properly. So the timing of the buy develops as follows. We have a macro stage 2. However, we have a micro stage 3, which is basically where? The topping period. Okay, so yeah, macro is stage 2 uptrend. However, the small time frames are getting a little bit too high and more high probability for that to potentially correct. Okay, so we're waiting. Okay, so we're waiting. Okay, I'll put that in red. Okay, we're waiting. Wait. Okay, macro stage 2 with a micro stage 4. well, this is good. This is not bad. This is good. The prices are coming down. Okay, well, Eric, I want to buy. Why are you saying that it's good that it's coming down? Well, think about it. If you want to buy something, don't you want the price to come down to get it cheaper? Okay, of course. You do that at the grocery store. So why don't you do that with your trading? Okay, I'm not buying on the way up. No, that's retail. I want to analyze and I want to buy and trigger a point on lower pricing. Buy low, sell high. Okay, so let that come down. Let that come down. All right, so macro stage 2 with the micro stage 4, that means it's a short-term pullback, correctional wave. We're waiting. Fair enough. Macro stage 2 with the micro stage 1. Uh-oh, something is happening here. Okay, it's starting to form some bottoming tails. It's starting to come into prior support, resistance, demand, etc. Okay, we'll talk about this in more detail. Okay, so we're still waiting, but we're getting ready. We're getting ready. Getting ready for what, Eric? Okay, well, here it is. If we're going to get it, it could be this. Macro stage 2 with a micro stage 2. We strike, match. It's a strike match. Meaning, what do you mean by that? Well, it already went through its cycle of 1, new wave high, impulse, correction stage 4, bottoming period stage, okay? And then we're starting to do what's called getting some more buyers. We're getting some buyers taking back over this uptrend. So once that happens, now we have a match. Match of what? Macro stage 2 up, micro stage 2 up. Trigger, get in. Okay, I'm going to talk about stop losses and targets and things like that on the next couple of slides. I'm giving you the step-by-step process. Okay, step-by-step process. If I were to just show you this really briefly, if I just kind of kick out, okay, so that's the match. Stage 2 up, stage 2 up on macro, stage 2 up on micro, match trigger, strike. If I kind of just show you this really briefly, we talked about this in SPYs yesterday on the 60-minute time frame. Not to get too off track here, but we talked about these 20 and 50s. Remember, we talked about the buy zone here. Well, we haven't talked about it, but I gave a little bit of insight here. Okay, so here we have impulse correction, impulse correction. All right, I'll just use this one right here as an example. Okay, here we have a pullback into support demand. Okay, here's the buy zone, which we're going to be covering today. And then we had what? Basically stage 2 up on daily, stage 2 up on weekly. This is the 60-minute time frame. And right here where this circle is, here's where we have, if I just clean this up a bit here. I'm getting too excited already. Okay. So we have stage 4, down, red, 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 red. All of a sudden something happens right here. This is where you have stage match, COG. Okay, where buyers took back over in prior resistance, now support in our buy zone, which we're going to be discussing today. And then this is going to be what's called a stage match right here. This is a stage match. There it is right there, match stage from dailies in 60-minute time frames, okay, which we talked about yesterday. So you see how there's a red bar, okay, this is positive COG. Green bar is taking out red, okay, in the context of an uptrend after the stage 4 down, okay? And then look, correctional wave, what happened next? Impulse, okay? All right, so this is what we're going to be, this is what we're talking about. I like to give chart examples as well as I'm following through with this process here. All right, so let's continue. Markets are about to open up. Futures. All right, you're gonna hear the bell ring in about a minute, so cover your ears because I think the volume's up on this computer. Okay. Let me just take a peek at one thing, folks. I don't want to take too much time from class, but you know, I am a real trader here, so I just want to analyze something really briefly. I just want to get SPX pulled up really briefly. We are going to be having a gap down on SPYs. VIX is up 7%. Wow. Okay. So PPI came out a little bit more hotter than expected. There's some news today, but SPYs have been stuck. Markets have been kind of range bound here. So we kind of need a catalyst to kick us out of this range that we're having. We're going to be having a gap down. We are going to be having what's called a mortgage gap down, which is gaps that I can have a whole lesson on, separate lesson. been talking to the team. We're going to be having some separate sessions on here. So you're going to be having a mortgage gap down. So SPX is going to be gapping down to basically about 4,000. So we still have to clear this even number here. So I'll be patient. I don't want to take too much time away from class here, but you know, I'm always going to have my eye on this market, ready to pull trigger. All right, so I'm just going to get this prepared for myself really briefly, then I'll move on. I don't want to take anybody's time here. So 30, so we're going to be capping down above 40,000. So 4,100 minus 30 gives us to 70. So I'm just going to prepare this options trade really briefly. And I'll be kind of looking at this for a trigger. Okay, appreciate that. Let's get back on topic here. And there she is, she's open. All right, hold on a second here. Actually, let me check one thing. So SPY's gap down. Okay, we didn't clear this area here. All right, I'll have some time here on this. Google changed a lot from yesterday's setup. Google does look pretty decent. What we were planning on this for long calls. The setup isn't as potent as what it was yesterday. But calls, we could do at the money calls 156. It's a decent setup. I put my stop here at 94. The only thing I don't like about it is we're in the sell zone on the 60-minute time frame. So I'll just pause on that. Things are not as clear as what they were. And again, I don't want to take too much time away from class here. All right. I'll come back to that in a bit. Okay, so there's going to be a couple of things that we need to be looking for. And what are those things? So this is the abbreviation stock buy setup. Okay, so the stock buy setup. The stock buy setup is made up of only one key criterion. All right, and it is the key to capturing robust 3 to 5 bar gains. Okay, so typically once you get that positive COG, you'll typically have what's called a flush out into new highs. Okay, that's basically what this is saying. It might take more than 3 to 5 bars, of course. Okay, not everything is picture perfect. Okay, but that's fine. Okay, just because we get into a stock or a trade doesn't mean that it's going to go just for us. Okay, so it might take more than that. All right, but this is just a general kind of rule. The stock trade trader can often use this one setup alone to trade any market. All right, the stock buy setup can be found and traded on all time frames. All right, this is key right here. Okay, because I often get asked, well, Eric, you know, I see you executing, say, like on a 30-minute time frame or a 5-minute time frame. Does this work on the daily time frame? Of course it does. Right, just your frequency of trade would be different. But I would even say, okay, when you have, if this is a daily chart right here, okay, if this is a daily chart and you have a buy setup on the daily chart coming into the 20 EMA, okay, coming in right over here. Okay, well, the 5-minute and the 60-minute and the 30 minutes are going to fly because the daily charts have their buy set up. Does that make sense? So that's the whole point of this strategy, is matching the higher time frames with the small time frames. So if you see these setups on a higher time frame, the small time frames are going to be controlled by those high time frames. Okay, so it doesn't really matter about what time frame because it works in all time frames. All right, the markets are fractal in nature. All right, they're fractal in nature. All right, meaning that it's all numbers, all right, and there's just waves of corrections, impulse corrections, impulse corrections. Okay, so when the daily is pulling back into the, say, the 20 period moving average, okay, that means that that's going to be better prices on the daily time frame. So anything below the daily time frame is going to fly in the event that the daily time frame is going to go from its buy setup in this example. Okay. So we have green bar, green bar, green bar, green bar, green bar, topping period 3. Then we have red bar, red bar, red bar, which is stage 4. And then we're going to be waiting for stage 1, which is going to be that bottoming period. Okay. And this is going to be where we have what's called a setup. Okay. The buy setup. All right. So this is what the setup looks like. Main criteria, stock buy setup. Okay. 3 or more. Okay. 3 or more as a minimum, consecutive lower highs or red bars. Okay. So remember, This is an uptrend, yeah? Stage 2, buy setup, okay? So just think, scaling out, okay? Scaling out, we have a pattern that is giving us higher high, higher lows, all right? So this is gonna be that stage 2 wave here, okay? Right up here, I'm drawing it right here. Stage 2 up, green bar, topping period, stage 3, topping period, stage 3. Then as a criteria, 3 or more consecutive either red bars or lower highs. So you can see here's red bar 1, red bar 2, red bar 3. Having both makes the setup more potent, meaning that these red bars have a nice lower low, lower high segment, okay? Because what you really want to see is a nice kind of tight V coming in, okay? What you want to see is a nice tight V coming in, V kind of like a V top, and this is going to potentially be setting up like a nice V bottom. So I want that to come in nice and clean, coming back into my zone, or my area of interest. Okay, so focusing on this stage 4 segment down right now. All right. Optional 3 or more consecutive lower lows. Okay, so in this particular example, you know, it's making lower low, lower, lower low, lower highs. One thing that I would say, just trading over 14 years, almost 15, you know, you don't need to really like look at the wicks and the lower lows coming in on the stage 4. All right. More importantly, I would like to see red bars coming in, and even more importantly, I would want to look left and to see what this down pricing, this stage 4 is coming into looking left. AKA, I would want to see a level of demand, support here to the left, etc. Okay, so what's more important than these couple of general tips here is what I just mentioned right here. Is what this, and you might want to write that down, is on this stage 4 temporary correction down, what level is it coming into here to the left? Okay, and I'm just going to use Google as a quick example. Okay, because we talked a lot about Google yesterday. All right, so if I look here, folks, okay, now the topic that we're discussing is, look at, we had 1, 2, 3, like 3 to 4 red bars, what have you, right? But more importantly than whatever, 3, 5, 8 bars red is looking left. See how this is the stage 4 coming down into Google, which we analyzed yesterday, if you caught up on the recordings there. Okay, because we did a whole macro stage picture on this, right? So I just want to bring your attention just to this focus right now and this topic right here, okay? Is going to be, regardless of counting the candles and lower low, lower highs and things like that, it's where is that stage 4 coming down into looking left, okay? And you see how it came right into this level of a rally, basing, and we have a big move out that kicked a new high segment on weekly highs here. All right, so this level to the left was even more important than whatever, 3, 4 red bars or 8 red bars. Does that make sense? So that is the key thing that I want you to take away from here, is going to be look left and see what that pricing is coming into, AKA demand in this example, because we're looking at a bullish setup. Okay, so that's just a couple of, in addition to the tips that is on the slides, I gave you all additional tips, just, you know, personal, okay? So that's going to be the setup. Impulse, correctional wave. I would want to see more importantly what that level of demand is coming into right here. So here's demand or support. Okay, and then we're coming down, 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 and then this is going to be the area of we're going to be looking to plan that attack where we might be potentially having that match stage. Okay, now Anil is in the house. Good to see you, brother. And you had to kick out, and you had to go to you kicked out of the class yesterday, and you went to Randy's futures class, and he is a supply demand guru. I mean, Randy is so good at supply and demand that like he just triggers and enters right at those qualified zones here to the left. Okay, I do as well. Okay, yep, he's awesome at it, man. I mean, unbelievable at it, right? Jason too, right? We're all kind of professional traders, are all looking at the same thing here. The point that I'm trying to make is that this, right? These areas of demand, supply, okay, that are controlling the impulses, okay, we can be entering right at those areas here. What I would classify as like Randy style, right? Randy style, supply demand, right? And on top of that, this is the stock trading method course, because sometimes it doesn't get to the demand zone. Okay, sometimes it doesn't get to the demand zone. Like sometimes Randy and I will talk, and it's like, yeah, man, I had a level there, never got there. But when we have what's called positive COG, change of the guard, okay, the fact that it couldn't get to that demand zone shows that it's a strong stage 2 uptrend. Okay, so in addition to supply and demand, what this setup is going to give us is what's called a trigger in the event that we have that high quality demand zone or support zone to the left, but it doesn't get there. Does that make sense? And then, okay, because Randy's zone was so good, okay, that there was such high quality competition at those prices that it couldn't even get there. All right, but we still have a beautiful setup. All right, so this is going to allow us to get what's called an action or execution, which is going to be the next slide. Okay, so the action of this, okay, the action in trade management. How do we pull the trigger on this? Okay, so we're going to have red bar, red bar, red bar, red bar. And then we're going to buy when the stock trades above the prior bar's high. Okay, so let me slow down. Remember, we have impulse, we have correction. Let's say we had a Randy level of demand, super high quality, right down here. Okay, but it was so good that buyers just picked it up even before it got to this high quality level. Okay, but all of a sudden, something changes. Something changes. Listen to the language I'm talking about. Something changes. It's called changing of the guard. Okay, so we had, remember, we already matched our stages. So we have red bar, red bar, red bar. We have an area of planned attack right down in here, but for whatever reason, it's so strong of an uptrend that it does not get to that demand zone, and we have what's called a change. Okay, a changing of the guard. So we're going to be buying, if that happens, we're going to be buying above the prior bar's high. Now, if I look right here, this is the execution bar, the action, E for execution, or A for action. This is going to be the entry bar or candle. Well, why, Eric? Well, because we have, remember, this is going to be a match stage 2. Why? Well, because we have impulse, stage 2, topping, stage 3, correction, stage 4. And then what happens here, folks? Changing the guard, green bar takes out red. You buy above the prior bar's high because the prior bar's high is a red bar. Okay, red bar, where sellers were temporarily just taking a bit of control. But the buyers have control over all. Does that make sense? Okay, so once we break above that prior bar's high, as long as we have a setup, okay, we're gonna have more things in line to this. We get in, we get long. Okay, so we buy above the prior bar's high. In this case, it's going to be a red bar. So once that green bar takes out that red bar, that's called changing of the guard, which we would discuss. You enter right above that prior bar's high as an entry. Stop loss is placed where? Right below, okay, that entry bar's low, either here or below that what could be a potentially what's called a pivot. So I would put my stop below the prior bar's low. Okay, so stop loss is slightly below the current bar's low or the prior bar's low. All right, so let me clean this up. The coffee I'm drinking is like a double espresso right now, so I can feel it in my veins at this point. All right, so when we enter here, E for entry. Some traders put their stop right here, right below the bar's entry. I don't really like to do that, just me personally, because I don't like to have it too tight. Sometimes it does take a little time for the setup to go. So therefore, I elect to typically put my stop loss right here with this line here. Okay, so my stop would be right here. So this would be stop based on entry right here. So this bar getting taken out, this red bar getting taken out, that green bar is going to be the entry. Okay, back above this prior bar's high, red, match stage 2, stop below the prior bar's red bar. Okay, prior bar's red bar. So this is what this is talking about, place stop below the bar's low or the prior bar's low, which I just discussed. I like to do this one just because, I often find that that's a little bit too tight in most cases. After 2 bars go in your direction are complete, you could start to begin to place what's called a trail stop under each bar's low until the price objective is met, or a reversal bar has developed, or a gap up has occurred for swing trades. Okay, so basically what that's saying is essentially here's our target objective number 1, because here is the high. Okay, So this was just going to be the high. So this would be kind of like target one, so to speak. Now we're trading with trend, right? This is right. We're trading with trend. So we want to ride winners, right? So typically I'd like to have a target one at a prior high, and I like to have multiple targets, right? I have target two. I'll just put T2 here and kind of like T3 here because I want to ride that trend wave. Does that make sense? All right. So it's all about low risk, because here's my risk. If this is going to go, if this setup is going to have what's called a follow through, okay, my risk is right here, this red box, yeah? Okay, so let's just say that whatever, this is equated to, say, minus $100, just as a base case, okay? If we're risking one, we should have at least, a 2-to-1, 3-to-1, at least target number one, at least at a minimum, to qualify this trade, which we're going to be talking about as well. So I'll do this in kind of green for profit. So this is going to be target number one. So this should be at least minimum of like 2 to 3, 3 to 1, give or take. Okay, so you see how we have at least target objective number one, a higher reward on said risk. And then if we hit target two and target three, what's happening to our targets? They are a lot bigger than said what? Risk down here. Okay, so this could be plus 200 as target one. And I'm just giving some examples here. Target two could be like a 3 to 1, plus 300, etc. And then target three could be, plus, like 4 to 1, 500, what have you. I'm just giving this as an example. Okay, we all can do math here. Okay, the key takeaway is what? Okay, out on a setup, okay, small risk, okay, lower risk, proper stop loss placement, and then higher rewards. Okay, higher rewards. Okay. All right. So now, as a swing trader, now you might be saying, well, Eric, I'm not a day trader. Okay, how do I do this on a swing? All right, we have some notes here for that. All right, so you could be utilizing the 30-minute time frame. Okay, so just act like this is a candlestick chart and this is the 30-minute time frame. Okay, or the 30-minute time frame. So you can execute on the 30-minute time frame, which is kind of like an intraday time frame, but you can utilize that to help you with your swing entries. If you are a swing trader, like taking a couple trades per month, this could easily be the daily time frame, right? This could easily be the daily time frame for 4 days down into a weekly level of support or demand, or monthly, and then therefore you'd be entering like above your prior bar's day low. And this could be a multi-day, not a multi-day trade, a multi-day in terms of being in the trade for several days, if not maybe a week or two, or a couple of months, even if you're a position trader, which we're going to be talking a little bit about different styles of trade as well today. Okay, so that is the action. Okay, that is the action. Buy above prior bars, red high on a bullish setup. I'll give you a quick example here. As always, I think I was talking, actually, I'll use the work that we developed yesterday in class. And this was like I think it was just the 5-minute, okay? And it dipped in here. We have positive COGs. So we have red bar getting taken out by green, okay? And then we had another one here. And as you can see, we're riding the trend of that, of the day yesterday, okay? So this pulled back. Now we're in a stage 2 uptrend here, okay? So we pulled back and we had positive COG, changing of the guard. All right, so you get in, stop loss below here, and as you can see, new high. We've had another one here. Didn't even have to go to a live chart because we have a setup. We have an example here as well. So, a bit dated, but this is the perfect, so to speak. Nothing's ever perfect, but this is perfect stock buy setup. Okay, the green arrows on this illustration point to where the buy bars are, which we're going to be talking about. So here's a green arrow here, and here's a green arrow here. The red arrows signify where the trader has what's called a stop loss, because we have stop losses in professional trading. Okay, and then we have the setup. Just looking at price action over here on my right screen here. Stock buy setup. 3. So this is a stock buy setup. So we have an uptrend, yeah? Okay. Here's the 50 or the 20 period moving average. We talked about that yesterday. 3 consecutive lower highs. So here we have stage 4, red bar, red bar, red bar, red bar. So we have 4 of them. It's pulling back. Okay, it's pulling back in our level of demand to the right. Our rising 50, rising 20 EMA. All right, this is, look at this. This is even a daily chart. This is even a daily chart. Okay, so this is a swing trade. All right, or if you're a day trader, you're going to be still analyzing what the daily charts are doing to help you with your day trading. Okay, and then we have 3 consecutive lower lows in this particular case. Okay, great, more potent. Okay, and we have something changing right here. So this is a green bar right here. You see this bar? So we have stage 4, stage 4, stage 4, red bar, red bar, red bar. In this case, black bars, black bars, black bars. We're pulling back to that level of support demand. And then all of a sudden, something changes, rising 20, rising 50. We have green bars taking back over the red bars. Okay, so this is going to be where we'll be buying to enter on a bullish setup. This is where we have a buy entry signaled by that green arrow because we closed and broke above that prior bar's red body high. Okay. Stop loss, if we're wrong, is placed below that prior day low in this example, or the prior candle's low. All right. And then we have a target area. This is the previous high. So this is going to be target 1. Okay, T1. And then we're trading with trend, right? So we want to continue. So this would be where I'd be looking at T2, okay, T3, etc. Okay, now check out what happened here. Didn't get stopped out, but if we did, we would have lost small. And then in this trade, we're trading with trend, we won bigger. Okay, so quality trends, quality trades. Okay, if you're wrong, be wrong small. And when you're right, ride winners. That's what professional traders do. Retail traders are opposite. All right, they do not cut out proving themselves wrong. They want to be right all the time. Okay, they have no stop losses. It'll come back. It'll come back. It'll come. No, just be wrong. Be wrong very small, quick. Boom, boom, boom. Out, out, out. Failures, out, failure, out. Okay, and then if you're doing that religiously and you are qualifying and sticking to a strategic strategy with discipline and emotional control, you are going to have bigger winners if you allow yourself to have bigger winners with management. Okay, so that being said, we hit multiple targets here in this example here, okay? But check this out. We even have another setup lining up. So see how this is a correctional wave down here where we have a V, okay? We have a top V and a bottom V. Over here, we have another setup right here happening, and this is a consolidation, but this is a sideways consolidation, okay? So one of the things that we didn't discuss yesterday is every time you have an uptrend, it doesn't always have to be a V structure. It could have what's called a sideways base, okay, for a breakout, okay? And this is giving us that as well. So we have what's called the bottoming tail here. And I put this on the candlestick document that I developed here. So we do have a bottoming tail here. We have a sideways basing in the context of a stage 2 uptrend. And then what happens, this is what's called a breakout, okay? So we broke out. We have green bar getting taken out, okay? Green bar taking out this prior bar's high, and then we have continuation in said trend, okay? So this is giving us another area to buy. All right. So again, on top of professional traders cutting out very wrong and small and winners ride, professional traders also do what's called add. They add to winners. Okay. I love adding to winners. Okay. One of my mentors always told me, it's like, Eric, the trend's not done. Keep going. Okay. Right. Keep going. Okay. It's not just one trade mentality. Okay, that's what I find a lot of traders, a lot of new traders, like people that want to trade, like this is like everything's just about one trade. No, it's about the whole position. Okay, it's about the whole position. Okay, so in this particular case, I mean, when trades really work out really well, you and the trends are really good, you want to keep working on that trend. Okay, just like a surfer, if like the waves are really good, right? Maybe they only wanted to surf for like an hour, but it's like, wow, these waves are really ripping. Like, let me stay out right now and have some fun because the conditions are really good. Okay, does that make sense? Because sometimes with trading, the conditions are not so good, right? It's raining outside, you can't surf. Snowing outside in Boston, you can't do what you wanted to do prior because it wasn't right. So things change. So when the conditions are good, okay, that's when you got to take advantage of those said good conditions. Okay, so the point that I'm trying to make here is retail traders hang on to losers hoping that it comes back. Okay, they assume bigger losses, okay, and anytime they have a small little gain, they're quick to take those gains. That's why their cumulative curve goes like something like this that we talked about. Okay, I'm going to talk about expectancy. Overall, they slow drown, slow bleeding death. Okay, where a professional cumulative curve looks something like this. Like this, they have losers, but they're very small. Does that make sense? But overall, cumulative curve, equity on growth, looks something like this. Small loss, small loss, small loss, bigger wins. Small loss, bigger wins. Small loss, small loss, small loss, smaller, bigger wins. Make sense? Okay. So professional traders, they hang on to winners and they add to said winners. Okay. With managed trail risk management. Retail traders, okay, they hang on to losers and typically they add to losers, to be honest with you. Not everybody, but most people do. Okay. I did too when I first didn't know what I was doing trading. Okay. Oh, they bottom cost average. Oh, let me add more. I got a better, right? And they're literally adding to losers with the hope that it might come back. Does that make sense? Whereas professional trading, they cut losers like, Anil's in the house, right? He saw me cut losers very quick. Okay. I don't even think about it. It's just out, 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 out. Okay. All right. I'm getting too early for that. So here's an example. We talked about the buy setup. So here's a nice example. We talked about this yesterday, right? And I was using train tracks as an example. I know that's kind of a weird topic right now because of what's happening in America that I mentioned. So here's the rising 20 EMA. Here is the rising 50 EMA. We have, again, it's not just about moving averages. Okay, it's more about the level and the price. Okay. But we have structure. Obviously, this is impulse correction, higher high, higher low. Great. Okay, and it's an uptrend. So here we have pullback into the 20 period moving average. We have support being respected here. Okay, red bars getting taken out by green bars. Okay, changing of the guard, get in. And here we have what's called the setup right here. So we have red bar, red bar, red bar, red bar, red bar. Looking to the left, doesn't this look exactly like Google? Right, we have a rally, a basing, big move out, rally. Okay, dip, price comes back in, stage 4, 1, 2, 3, 4, 5 red bars. Look at this, green bar takes out red. Get in right above here, stop loss right here. Okay, enjoy your wave. Take profit, number 1 here. New highs, TP. Topping tail here, coming back in, prior level of demand or support. Rising 20 EMA, rising 50, good. We have a bottoming tail. Here's another setup. Once this bar breaks out to the green bar, takes out this red bar, get back in, ride the next wave. Okay, now I'm making it look pretty simple. Trading is very simple in nature. It's difficult because human beings, emotional, behavioral finance, if you study that, all right, we are born to really suck, excuse my language, but to stink at trading and speculation. Okay, we're risk aversion human beings. All right, so we shy away from risk. Part of being a trader is being comfortable with being uncomfortable, being comfortable with the risk. If you do not feel comfortable with the risk, okay, then you should be trading size or position size to where you're comfortable taking those small losses. Okay, in that comfort, okay, comes positive gains. You have to be comfortable with risk, putting on risk. Okay, that's part of being a trader. Okay, moving on. This already talked about this. I kind of illustrated that right here. So we're going to be buying above prior bar highs. Okay, so these arrows here are where we talked about. So these green lines, if I just kind of clean this up, is where we have the stage matches in terms of the macro and micro. And then we have the short-term setup here with the red bars coming in, prior level of demand support, context of an uptrend. This green line here represents where you'd be entering, because right when we break that red bar high, get in, stop loss placed right below, where does it say here? Place stop below the current bar's low, okay, which would be this one right here. Okay, same thing here. This is setting up. If we have a move up above that bottoming tail, stop loss is going to be placed below there.